Welcome, it's Drew Blazsik with Logos and Markets. In this video, we're going to go over the three-statement model. So we're going to have all the schedules completed and finished. And what we're going to do after that's completed, we're going to plug in the income statement, the cash flow statement, and the balance sheet, and I will explain it. And again, in the comments below the show notes from Logos and Markets website, you can download the Excel file that's ran by the sim method. It lights up green if you get it correct, and if you don't get it correct, it will stay the same. So follow along, download the file. Let's get started. And as you can see, the income statement is blank. I left it gray for us to plug in the numbers. The balance sheet, cash flow statement, and then everything else is complete. If it's lit up green, the numbers are correct. If it's not lit up green, it means the number is not correct, but we have the correct function equation in there. Let's look at the grade. I always recommend my students to go to the grade to look at how well did you, or how well are you doing in this? And then also you can see how it's connected. So what we have here, the income, cash flow, balance have zeros. We have not completed it. And the overall grade is going to be are the numbers correct? And the weighted grade, did you do it correct? As you can see, that the working capital, the income statement, equity, and debt are all affected by not having the income statement and the cash flow statement complete. So let's get to it. We're going to begin with the income statement. The first part of the income statement, we have net revenue. And what we want to do here, I'm going to do the totals, is I'm going to go the gross revenue minus the freight and warehousing. That's going to be our net. I'm going to hold down Shift, Control R. And now what we're going to do is look at the forecasted years. So we want to forecast gross revenue of freight and warehousing. That's from the revenue schedule. So I'm going to plug that in, and we're going to go straight up to the revenue schedule. And you see by revenue, we got gross revenue, and then underneath that is freight and warehousing. Once I plug that in, all I have to do is hit Shift, Control D. That's the next number, and we can fill in the rest. Next is our cost part of the income statement. That's going to be a sum. I'm going to sum up cost of sales and the SG&A. So we're going to sum those up, do the totaling across. And now we want to plug in and we want to forecast SG&A in this situation here. So we got cost of sales. That's going to be in the cost schedule. That's going to be right above. And what you want to make sure you select is the total cost in millions. And then now the SG&A, this is going to be in our assumptions page. And we're going to project. We're going to make an assumption of what the first forecasted year is going to be. So I'm going to assumptions. If you scroll up a bit, 3.9 million, and we say it grows at the rate of inflation. Okay, so after the 3.9, okay, let's go to the rate of inflation. So I'm going to show you an incorrect of doing it in the sim method, why it's powerful to teach you instantly, is I'm going to hit equals, and what we want to do is grow that SG&A at the rate of inflation. So we're going to do the previous multiplied times 1 plus. I'm going to go to the scenarios tab. I'm going to hit that first 2022 rate of inflation. I'm going to close it up. And if you notice, it is incorrect. Okay, so this is the power of the sim method. Right away, it's going to tell you did something incorrect and you want to know why. Well, what you're going to do, what I did was I went to the scenarios. In this example, we made the projected cost of SG&A 3.9, and then we want to find out and project out to 2023. Well, I grabbed the inflation rate from 2022. I grabbed the wrong one. So what we want to do is do it over. I'm going to hit 2023 projected is going to be the previous, multiply times 1 plus. And what I'm going to do here, I'm going to go straight up to the cost schedule, which I already have inflation in there, and we want 2023, not 22. That's going to mess up our projections if we got that incorrect. And now that's correct. Okay, so what we're going to do is Control R. We filled in the cost section. Next, we want EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And how we solve that is we're going to take our net revenue and we're going to subtract out the total cost, okay? Total cost of sales, and SG&A. And then this is important. The cost adjustment is a gain or a minus or a subtraction. So what I'm going to do, if you notice the other costs we have as positive and we're subtracting it, since this could be a gain or loss, I'm going to say plus, because that number, if it's a loss, will be a negative. If it's positive, it'll be a plus, a positive number. So we're just going to add it rather than subtract. It would not work that way. Next, what we want to do is the cost adjustment. If your boss or your company did not make an assumption on that, you can go in and say, you know what, our assumption of a cost investment or adjustment is going to be 0. So that's what we said. I'm going to drag that out. Now we got the EBITDA. Next, we want operational income. That's earnings before interest and taxes. So what I'm going to do here is just take the previous calculated field and I'm going to subtract out the depreciation. And again, depreciation is considered a cost, not a direct outlay, but a cost. So what I'm doing here is hit the minus because it's a positive number. Okay, drag that across. Next, we want to go is to the projected years. I need to go to the depreciation schedule. And we're going to hit the projected. Oh, sorry, I went a little too low. The projected year. Depreciation, bring that up. I'm going to highlight those two, drag those across. And you see with Sim, you really want to get efficient and quick with this. Hit the reset button. I'll show you at the end of this video. You could keep on practicing until you get this down real quick. Next, we want earnings before taxes. So if we had earnings before interest and taxes, we need to subtract out the interest expense to get the earnings before taxes. I'm going to drag that over, and what we want to do is plug in the interest, and that's going to be found on the debt schedule, the very bottom down there, the net interest expense. Bring it in, and we'll drag that across. You did it correct, but those numbers are not correct. The numbers are not correct, but you did it correct. The numbers will be correct once we fill out the cash flow statement and go further on. Next is our total income taxes. You got two kind of taxes. We got current taxes that we actually had to pay, and then we got, because of timing differences, the government lets us to defer the tax to a later period. We got deferred income taxes for some other time. So what we're going to do is we're going to sum those up. It's important to note that the income statement, even though the deferred tax is not something we're costing us today, we are subtracting it. So this is not a good teller of our cash, how much cash we have. So the cash flow statement, keep that in mind. We're going to have to add back in deferred taxes because it wasn't a cost from the beginning. It'll be a later time we're doing that. So what I need to include in here, we need to get the projected current and deferred. So I'm going to select that. If you notice that we have current taxes and we got deferred underneath, just like our income statement. So I'm going to select the first cell, drag it down. I got both of those to drag across. It's important to note on this what deferred is again. So watch the video about income tax. I'll explain it thoroughly there. But deferred, just remember that. It means I'm deferring it at a later period because of timing differences. So I'm going to select that first cell. We got the current, bring it down. Now you can do this if you want to get really quick. I'm going to hit Control D R, and that fills it in pretty quick. So D controlled fill down and then to the right. And then we'll fill in the totals going across. You notice that we have some are not green. We did it correct. If you want to make sure you did it correct, you can go to your grade and you can see we got 68% of the numbers are correct, 82% we've completed, which means we've done the right function 82% of the income statement. Next are net income. So we had income before taxes. So we're going to take that value, the last calculated field, and I'm going to subtract out the total income taxes that we're paying. I'll drag that across. And then what we have here is we got net income, and then we got, and you got to be very careful when we add these up, what it means. I got another section of preferred dividend. This is if we're doing financing activities. We have preferred dividends we must pay if we want to raise money for financing. Right now we have zero, but we have to get the projected dividend in, the preferred dividend. That's going to be all the way to the bottom in our equity schedule. So you want to look at preferred right there, $0.22. And if you can see, we did issue some preferred stock, which means we're going to have to pay 10% of that later on. I'm going to enter. That is correct. I'm going to drag that to the right. And then all I do here, net to common, I'm going to take the net income. I'm going to subtract out the financing activity of preferred dividends and bring that across. So it did adjust some numbers. Right now, we're not all the way there. My income statement, I'm 100% complete. It's important to see, 100% complete. However, I have 79% of the income statement with correct numbers. Okay, next we got the cash flow statement, and I will do the margins at the very end of this video. Cash flow statement. So you want to think about what is the cash flow statement? That's a change in cash. What effect does that have today in our cash value? So we're going to look at all these. We got three different kind of cash flow activities. We got operations of the business. We have investing, and then we have financing. Just remember, investing is you buy a new property, a new equipment. Operations is how your company is actually running with net income. And then you got financing, which is the revolver for a sweep account. If you go into debt, you got long-term debt. You have dividends, you have issuance of new stock, you got tons of stuff, how we could finance, raise money two ways, equity and debt. That'll be in the finance part. Okay, so what I'm gonna do here in the cash flow statement, let's just sum up the values here. I'm gonna do that for all these. Let's get that out of the way. We'll sum those up, Control R, and then. All right, so we got operations. So I want you to think about this, is how much cash do we have from our income statement, okay? So the first thing we want to do is plug in our income. So I'm going to go straight up here, and I'm going to find our, this is important, the income, not after we subtracted out dividends. The reason is real important. Some students will select that one, which would be incorrect. The reason is in the financing activities, we take an effect, we put in there of paying out the dividend. So if I did the net income to common, if I drag that in there, I input it in there, that would take out dividends twice, preferred dividends. So we want that first income for operation. Depreciation, right? We made 37.3 million. Depreciation was never a cost. So I'm going to go straight up to depreciation and bring that in, right? I'm going to have to add it back in. It was never a cost. Next is deferred income taxes. Deferred income taxes, that was not a cost that year, even though the income statement, we subtracted it. So I'm going to add it back in, deferred income tax right above. And then last is changes in working capital. Okay. I have a video on working capital. Take a look. I'll explain it much more thoroughly. I'll briefly explain it here. If you had 30% of your customers buying credit, right? We take that into account. And then the next year we get that money from that credit, and the next year we have 30%. Now, what if you had 100% people buying credit? You have a guy that someone purchased $1 million on credit, which means on the income statement it shows you made money. However, we're not going to get that till the next period, till the next year. Okay, whatever the period, it could be next month, year. So we have to show the change in working capital. Are more people buying on credit? So if assets go up, our cash goes down. If current liabilities goes up, right? Think about personally, if you took $1 million loan, you go in more debt, my liabilities go up. However, I have $1 million more cash in my bank account. So if liabilities goes up, my money goes up. If assets goes up, current assets, it goes down. So what we want to do, we're going to plug in at the working capital schedule. and we're going to do the change. Make sure you select the correct year, which is 2022, the first projected year, the change in working capital. So I'm going to highlight those three, or I'm sorry, four, and then Control R. Okay, depreciation is the depreciation of CapEx. Okay, that's CapEx. It was never a cost, so we added the depreciation back in. However, we did purchase capital expenditures, and we did not take into account on the income statement. There's no capital expenditures. We just subtracted out the depreciation of the capital expenditures. So I have to show that CapEx purchase of 16 million in this example was a negative, right? If I purchase that, it declines my cash value. If I sell CapEx, it's a positive number. That means I make money. So what we want to show, I'm going to hit equals negative, and I'm going to go to the assumptions page, and I'm going to hit that first projected year of capital expenditure. Make sure it's a negative, and then we got other. I'm going to hit a negative there as well, and I'm going to go to our assumptions and hit the investing activities. We made the assumption is 0. And you can do that if there's no mention in the case study and you look at the cash flow statement and you see other, make an assumption that is 0, makes it much easier. And that fills out. Last is our financing. How are we financing our activities? How do we purchase that capital expenditure? Okay, so if we took on more debt, let's say we took on 16 million of debt, well, that means we paid 16 million as a negative, but then the financing is positive. We took on 16 million. So what we want to do is look at all the ways we do it. So you want to think about, we got the revolver, and you really want to, I mean, this is very important. You want to communicate this. Close your eyes and think about the financing activities. And can you think of all the line items that we have there? So the first one is the revolver, short-term debt. I'm going to go all the way to the debt schedule, and we want to know what is the change. This is cash flow, the change in the revolver. The revolver, we have the beginning, we got the end, right? I don't want those. That's just for the balance sheet. I want the change, which is the additions and repayment. Next is the repayment of variable debt, the repayment of fixed debt. Are we issuing new stock, preferred stock, to raise money? Or are we buying back? So if we issue more, it'd be a positive. If we're buying back, that'd be a negative on cash. Common shares as well. So those next 4 will be an assumption. And what I always do is line them up together with the cash flow statement, line them up. So then all you have to do is select that one. And what you can do is you can go to the cash flow statement, highlight those 4, copy that, go to the assumptions page, and put it in there and make the assumptions for each one. It makes it so much easier. Once you make that assumption, all I have to do is Control D, brings it right in. Last but not least, we got preferred dividends. This is the cost of, we might make a bunch of money with our cash flow by issuing new preferred stock. However, it's going to cost us something each year because we got to pay 10% each time. So what I'm going to do, hit equal. The last 2 are going to be found in the equity part. And I have the preferred dividend. That shows a positive. However, that's a cost outflow. That's what I have to pay the preferred shareholders. So this is going to be shown as a negative. Very important. This must be a negative on the cash flow statement. And then last, we have common stock dividends. And then that's going to be right below it. Negative 7.5. Okay, so we got the cash flow. I'm going to highlight those values, and you'll see a bunch of stuff will all of a sudden light up green. It's looking much better. We're not there yet. What we're waiting on here is the final part is now we're going to plug in what is our change in cash position, what is our beginning balance, what is our ending balance. So first off, what from the year, from operations, investing, and financing, how did that impact our cash? So what we're going to do is we're going to say equals. I'm going to add the financing costs, which was negative 27.8. I'm going to add the investing, which was negative 19.1, and then plus I'm going to add the operations, which was a positive operating cash flow of 32.2 equals. So we lost 14.7 million that year. And then right below that, the beginning balance of the cash flow statement would have been the ending balance of the previous year of 2018. So you would have to go back to the accounting and look at 2018 to bring in the beginning. And then what we want to know, what is our ending balance in cash? Well, that's going to be the beginning balance plus the change of cash from operation, investing, and financing, all equals. All right, so what we want to do here is, now I'm going to do one more row. I'm going to go the beginning bound or column. The beginning is the ending of the previous year. Tie that together. And then the change of cash position, I already did the equation. I'm going to drag that over. And then I'm going to all equals sum those up. And now all we have to do, and watch it turn green, everything lines up. The income statement's finally complete. I'm going to go to our grade to make sure the income statement, the equations are 100%, the numbers are 100%. You know that because it's green. And then last but not least, we want to get the balance sheet. All right, what I'm going to do with the balance sheet, the cash flow statement is a change of cash, right? The balance sheet is a balance. So what you're going to do is go to these different schedules, and we want to find the ending balance. It's a balance of some variable that we have here. So cash flow is a change in cash. This is the ending balance. So what I'm going to do is I'm going to sum up all these. That's the current assets. We'll sum that up. I'm going to do that with this balance sheet. Just get it over real quick. And we got long-term assets. Remember, current assets by definition are assets that would be converted to cash within a year. Long-term is longer than a year. We're going to add them up to get the total assets that we have. And then we'll do current liabilities. Remember, that's what we owe within a year that we have to use cash. And then we got long-term liabilities. It's debt or stuff that will pay longer than a year. And then we got total liabilities. And that's going to be long-term plus current. And then we got equity, because remember, assets equals liabilities plus equity. Equity is our preferred stock. Now, preferred stock is kind of like a hybrid of debt, but it is a share of the company. Common shares. So if you buy a share of a company, you own part of the company. Equity. And then retained earnings. What is retained earnings? The company makes money, right? Net profit. You either could pay out the shareholders, the dividends. You could pay off stuff like that, repay off debt, or you can reinvest it back in the company. So I'm going to sum those up. And then we have our total liabilities and equity. So I'm going to add up the equity plus our liabilities. And then we'll start plugging in our numbers. So it balances so far because we got a bunch of zeros up there. And we want to make sure we add all those up. Okay, so first part is our assets. So I want you to think about this, is that the top part of current assets is cash, okay? And then the rest of those are going to be found in the working capital schedule. Why is that important to remember? When you're creating a financial model, and you have to remember, balance sheet you'll be given the actual years, 19, 20, and 21, this example. So if you have to make a working capital schedule, you ignore the first variable, right? The first line is cash, and it's by liquidity, how it's listed. You have 1, 2, 3, 4 part of working capital. 4 current assets that you can just copy and bring it down. That's very important. So first I'm going to do cash. Well, this is a balance. Where do we find cash? We find it in our cash flow statement. I have change in cash. I have beginning and ending. This is a balance. I want the ending. Next is accounts receivable. I want the total amount that people owe me. Okay? It's an asset. right? It's a contract. You have some, you still owe me something. That's the accounts receivable. I'm gonna go all the way down to the working capital schedule. Now it's important that what you do, oh, well, too far down. What you do is you copy paste that balance sheet. All right, I'm gonna redo it. It's important when you create the working capital schedule, you go to the balance sheet and you copy cash, right? You take that off and then you copy those four. And what you do is you count days in, 1, 2, 3, 4. You want to line those up with the balance sheet and 1, 2, 3, 4. So what we're going to do here is we're going to input in our account balances, not the days in. We want the account balances, really important. People mess that up all the time. We want account balances in this example, and then that's going to give us our first projected year. And like I said, since we copied paste that order and we solved the account balances, that's going to be perfectly lined up with that. Highlight it over. All right, next is we want our total long-term assets. It's an ending balance. Unlike accounts receivable, unlike cash, I didn't have it calculated, so we're going to have to calculate it here. I don't have a schedule that did that. So what I'm going to do is I'm going to take the previous long-term assets I have, and I'm going to subtract out how those assets depreciated, right? They lost value. It's like I have a car that's 50,000. That's my asset. Well, next year it's worth 45, 42,000. At lost value, I have to add that in there. And then plus, I'm going to add something. I'm going to go to assumptions. And I want to know my long-term assets while I'm purchasing these capital expenditures per year. So again, it's my previous assets minus depreciation plus my capital expenditure. And then we're going to do the same as the other. I'm going to go to the previous and I'm going to add in, go to the assumption and cash flow statement, investing activities. I'm going to add that 0. That's our assumption. So it's going to stay at 12. And then we got the assets filled out. Okay, next is liabilities, okay? Current assets, remember that had cash, and then we have 4 current assets that are on the working capital, very similar to current liabilities. The top is the revolver, like cash, right? And then the bottom 2 will be found in the working capital, the 2 underneath the 4 assets. So when you're creating the working capital, take the 4 assets and then copy paste the 2 current liabilities, and then you got your working capital items. All right, first thing I want to do, go to the revolver. I'm going to hit equals. I want to know my balance of the revolver. Here's my change of the revolver. I don't want that. That was for the cash flow. I want the ending balance right below it. Next, my accounts payable. And again, those 2 items are working capital. So revolver, cash, and then you take those out, and then the rest are working capital. So let's go. Remember, do not do the days in. I'm going to go to the balances, and it's that 19.1 accounts payable. They're lined up together. So you go shift, hit D down, control D. Next is deferred income taxes. So it's a balance, and I don't have a schedule that calculated the balance, unlike the debt schedule, the equity schedule. So what we have to do here, it's a balance of the previous deferred taxes plus, and I'm going to add in that change of deferred taxes. This thing will tell us, this line item here on deferred taxes, are we increasing or decreasing deferred taxes? And as you can tell, we are increasing it at the 1.8. Next, I want a total of, this is my long-term debt. I want my variable debt and my fixed debt. That's going to be found in our debt schedule. So I'm going to go to the variable debt. I want the ending balance of totals, the ending balance. And then the next one is my fixed debt. I want the ending balance of fixed debt. Highlight those, Control R. Looks almost all completed. Now what we want is the balances of equity. Okay, another tip. When you're creating the equity schedule, what items do you need in there? Well, go to the balance sheet, the equity portion of it. You need a section for preferred shares, common shares, and retained earnings. So the balance sheet will tell you what you need for equity. So what we want is balances of preferred, how much are out there. So it's the equity all the way down here. So I'm going to the ending balance. Oh, that was common. So I want ending of preferred. Next, I want the ending for common. What am I doing? Not going to the right spot there. Ending for common. And then I want the ending balance for our retained earnings. And that's the very bottom right down here. That's the ending balance on the equity. I'm going to highlight those over and then hit Control R. The balance sheet balances. Everything looks good. I'm going to go back to the grade. As you can see, we're 100% complete. 100% complete. Balance sheet balances. Everything looks great. So now let's go to our ratios and solve those. Okay, first thing we want to solve here is EBITDA margin. So what I'm going to do is find it right above, which is going to be on the income statement. I'm going to divide that by our net revenue. Next we want to find is what is the EBIT margin. So I'm going to take the EBIT and then divide that by the same thing, the revenue. And then on the bottom here, return on equity. This is important. I want that net income, not the net income to common. I'm going to divide it by our total equity, and that's going to be found on the balance sheet. Shareholders' equity, the total amount, what is returned on it, and then I can highlight those, bring those across. There you go. So we got the ratios complete. Okay, so that's the end of the video. That's for the financial statements. A couple things just to note is that if you want the Excel sheet, it's right below the video on Logos and Markets website. If you go to Logos and Markets, go find financial modeling, go to Sim Finance, and then go to financial modeling, and you'll see the actual file there. And then in the show notes of the YouTube video, you'll see the link to Logos and Markets. There you go. Thank you very much. If you have any questions, please leave a comment and like this page. Thank you. One thing I forgot to mention, I just want to make sure you understand on the financial model, if you scroll all the way up, if you want to practice and get good at this, right, all you have to do, this is for the financial statements, all you have to do is hit reset workbook for the worksheet. It takes a few seconds. Okay, once it's complete, if you scroll down and you see all the parts that we're working on for the financial statement, the income statement, the cash flow statement, and the balance sheet is erased, and you get to practice it again. So use that for your advantage. If you are unsure and you made some mistakes, keep on doing it until you get it down. Help you in your job, help you in your career. Thank you, and God bless.